J.Crew, the purveyor of preppy threads, could launch an IPO as early as 2014, industry sources say. The specialty retailer's patrons famously include President Barack Obama's family, and it is led by legendary merchandiser Mickey Drexler. The New York-based company was taken private in a leveraged buyout by private equity firm Leonard Green and TPG Capital in early 2011 for nearly $2.9 billion. But after issuing a $500 million dividend financed by PIK toggle notes, the mall-based company may now be eyeing an exit. PIK toggles can be a harbinger of an exit as they are more expensive forms of debt to service and can be quickly paid down with proceeds from an IPO. J.Crew also has high levels of debt at more than 6.5 times EBITDA, according to Moody's. To continue on a path back to an investment-grade debt rating, it needs to reduce its liabilities. Optically, it is better for an IPO's proceeds to go towards reducing debt rather than into the pockets of selling shareholders. By retaining their stakes, shareholders are seen as voting with confidence in the newly listed company's future, something potential investors like to see when weighing whether to buy shares. J.Crew has been a portfolio company of Leonard Green and TPG for almost 3 years now, and it is typical for PE firms to exit investments after holding them for 3 to 5 years. According to a source, an IPO was always the likely exit for J.Crew, and if the markets continue to be receptive of offerings, the timing could not be better. Fellow private equity-backed apparel retailers Burlington Coat Factory and Vince both saw their IPO spike by more than 40% in their first day of trading. And now that J.Crew has turned itself around, increasing EBITDA by more than 20% back to its historical level, it could well be valued at around 12 times EBITDA. That would provide a return to Leonard Green and TPG of more than 2 times the equity they sunk into the buyout of J.Crew. I'm Richard Collins with The Deal Report.